Hey, real quick, before you scroll past this video, I want you to pull up your credit score right now. Whatever that number is, 620, 700, 750, I want you to understand something. That number was not designed to help you. It was designed to help banks charge you more. And the difference between a good score and a great score on a 30-year mortgage, $80,000 out of your pocket. That is the trap nobody talks about. I'm Marcus. This is Macro Finance, and today we are getting into the trap that is hiding inside the one number that controls almost every major financial decision of your adult life. Your mortgage rate, your car loan, your apartment application, your insurance premium in some states, all of it runs through this one number that most Americans do not actually understand. And here is what makes today different from every other credit score video you have ever seen. I am not going to tell you to dispute errors or open a secured card. That is surface-level advice, because we are going deeper today. We are talking about how the credit score system was built, who it was built for, and the specific mechanics inside it that are quietly costing you tens of thousands of dollars without you ever realizing it. Let me make this real for you. Let's call her Maya. She's 31. She lives in Chicago. She has a full-time job, makes $72,000 a year, pays her bills on time. Always. Not almost always. Always. She has one credit card, $5,000 limit. She uses it every month, groceries, gas, subscriptions, and at the end of every month, she pays the full balance, every dollar. Never carries a balance, never pays interest. Maya is doing everything right. Her credit score? 680. Her coworker, Jason carries a $1,500 balance on 3 different cards. He pays the minimum every month. He has a car loan. He has a personal loan he took out 2 years ago. His score, 740. Maya is more financially responsible than Jason by every real-world measure, but Jason gets better mortgage rates. Jason gets approved for the apartment Maya got rejected from. Jason pays less for the same car loan. The credit score system is not measuring your financial health. It is measuring how profitable you are to lenders. And Maya, who costs banks almost nothing because she never pays interest, scores lower than Jason, who's making banks money every single month. That is not a bug. That is the design. Let me break down exactly how your credit score is calculated, because this is where the trap is hiding. Your FICO score is made up of 5 components: payment history, 35%, amounts owed, 30%, length of credit history, 15%, new credit, 10%, credit mix, 10%. That second one, amounts owed, is where Maya is getting destroyed. The system measures something called credit utilization. That is the percentage of your available credit that you are using at any given moment. The recommendation is to keep it under 30%. Maya's is 0%. She pays in full every month. Should be perfect, right? Here's where it gets really interesting. Your credit card company reports your balance to the bureaus once a month, and they report it on the statement closing date, not on the day you pay. So if Maya spends $2,000 on her $5,000 card and then pays it in full 3 days later, the bureau never sees the $0 balance. They see the $2,000. Her utilization looks like 40%, even though she paid every single dollar. She's being penalized for spending money she paid back, in full, on time. And there's nothing she can do about when her lender reports. She has no control over that date. The system is designed so that responsible spenders look riskier than they are. Let me break down exactly how your credit score is calculated, because this is the part that changes how you see this forever. The difference between a 620 credit score and a 760 credit score on a 30-year fixed mortgage for $300,000 is approximately 1.5 percentage points in interest. That sounds small. It is not small. 760 score at 7%, $2,098 a month. 620 score at 8.5%, $2,307 a month. That is $209 more every single month. Over 30 years, $75,240 in extra interest,
on the same house, same price, same down payment. Only difference? 3 digits on a screen. Now here's the number that should make you stop scrolling. The average American buys 3 homes in a lifetime. If that score gap follows them across all 3 purchases, $225,000 in extra interest, $250,000. Not stolen, just extracted, legally, by design. And look, if this is already landing differently than you expected, hit the like button right now. It takes 2 seconds. It tells me this kind of content matters, and I'll keep going deeper on the traps most channels never touch. Subscribe if you haven't, because what I'm about to show you about who actually owns your credit score and who profits every time a lender checks it is something most people never find out.
Let's keep going. Systemic angle. Here is the part nobody talks about. Equifax, TransUnion, Experian, 3 private companies. Not government agencies, not public utilities, private, for-profit corporations. And their business model is not selling your score to you. Their business model is selling your score to lenders. Every time a bank pulls your credit to decide whether to give you a loan, the bank pays the bureau, not you. The bank. The company that decides your financial trustworthiness is paid by the people who profit from charging you more. That is a conflict of interest so massive it would be illegal in almost any other industry. And it goes further. Those credit monitoring apps, the ones that send you weekly score updates and celebrate when you hit 700, they are not helping you. They give you fake credit stats that have no bearing on your actual credit. They exist to trick you into opening new credit accounts through them, because every time you open an account through their referral link, they get paid. The credit score industry generates over $15 billion a year. Almost none of that money comes from consumers. It comes from lenders. And lenders profit more when scores are lower and interest rates are higher. You do the math. So here is what Maya should do and what you can do right now, not tomorrow, today. Move 1. Time your payments strategically. Call your credit card company. Ask for your statement closing date. That is the date they report your balance to the bureaus. Pay your balance down to under 10% of your limit 3 to 5 days before that date, not the due date, the closing date. Maya's utilization drops from 40% to under 10% overnight. Her score goes up without changing a single spending habit. Move 2. Use the 45-day rate shopping window. Never let a lender pull your credit more than once in a 45-day window. All hard inquiries within 45 days count as one single inquiry under FICO's rate shopping rule. Most Americans do not know this exists, so they avoid shopping around because they fear hurting their score, and they end up paying the first rate they're offered. That fear is costing them thousands. Shop around, aggressively, within that 45-day window. Move 3. Check your actual FICO score. Go to myfico.com. The scores on Credit Karma, Mint, and most bank apps are Vantage Score, a different model that lenders almost never use. You may have a 720 on Credit Karma and a 680 on the score your mortgage lender actually pulls. Know your real number before you walk into any major financial decision. These 3 moves cost you nothing. They take 1 hour, and they can be worth tens of thousands of dollars over the life of your loans. The payoff. Maya is not bad with money. Maya is playing a game where nobody gave her the rule book. And the people who wrote the rules, the bureaus, the lenders, the monitoring apps, they profit when she stays confused. Your credit score is not a report card on your financial character. It is a pricing tool used by banks to determine how much money they can extract from you over your lifetime. The moment you understand that, you stop chasing the score and start learning the system. You cannot beat a trap you do not know exists. Now you know. Hit the like button right now.
It takes 2 seconds, and comment below. Did you know your closing date affects your credit? I want to know how many people this is the first time hearing this. I read every single one. I'm Marcus. This is Macro Finance, and we will see you in the next trap.